On today's hot sheet, I'm discussing home price predictions by the great Ivy Zelman, the preview of what the Fed is going to do as they convene on their meetings today and tomorrow, and renters mobilized by 25 consecutive months of year-over-year rent declines. I don't know if Jay Powell heard that, but he should. Today is Tuesday, September 16, 2025. I am Byron Lazine, and the hot sheet starts now. Live from Naples. Welcome into the hot sheet. Do the show every Monday through Thursday when markets are open, 9:30 on the East, 6:30 on the West. We give it away for free. This isn't one of those media companies that puts a paywall on free information. Best way to support what we're doing is subscribe down below to the YouTube channel. We go live on YouTube right at 9:30 on the East Coast when markets open. And Kim, thanks for being, and Dawn, thanks for being in the BAMX role play. We do that every Tuesday at 9 a.m. You go to school.com/BAMX if you want access to those exclusive role plays. But the free and simple way to support us is hit the subscribe button down below here on YouTube, or leave the hot sheet of review on Spotify or Apple if you listen to the replays there. All right. Big week. Obviously, we've got the Fed meeting coming up. I'm going to be leaving Naples here shortly, going to Orlando. If you are attending Sirhant's Sell It conference here in Orlando, or Jared James Advance, I'll be at both doing a fireside chat with Ryan Sirhant tomorrow morning at his event, and then doing a keynote at Jared James the morning of Thursday. Looking forward to both. Next week, we have BAM Camp in Scottsdale. All three of these events are sold out. Sorry if you're missing those. You can catch me in 37 days in Denver, Colorado. So October the 24th, 37 days from now, I'll be in Colorado at the Fusion Conference. There'll be a link down below to connect with that. Bobby, this, just so you know, this is not working here. We are connected because I haven't moved it off of role play. So I've got Bobby here with me because he's coming with me to Sirhant. And we're going to get right into the Ivy Zelman here talk. I just want to, as Bobby's looking at why this may or may not be working, I'll bring Haley, who's on the other side here, to go over to Ivy Zelman here just momentarily. So Ivy Zelman, you know how I feel about Ivy. If you're a fan of the hot sheet, she appeared on CNBC. She broke down why she expects home prices to, yes, go down in 2026. Good. What was the problem? You had to pick virtual camera. Okay. Didn't have to do that on Zoom. Anyways, Ivy Zelman predicting in 2026 that home prices will go down, but by how much? Haley, let's look at her outlook on home prices falling before they rebound. She's talking with CNBC's Diana Olick, and here's where Ivy Zelman thinks we're heading.
Take you back to 9 a.m. where you had 87 slides on the state of the housing market, but the most interesting one to me was where you said that home prices will go down next year before coming up again in 2027. How do you see that?
Well, it's really a tale of two geographies regionally. We have geographies that were the COVID winners, and now they're decelerating as we're seeing net migration under pressure, even lower in some states than it was in 2019, as well as really elevated resale inventory. And the inventory is then being pushed, even prices being pushed lower, because the home builders, their market share has grown so much in those markets. They've oversupplied the markets with spec. So when you add that, lastly, employment, you're looking at those markets that will be pressured. Whereas the other side of the coin are markets in the Northeast and the Midwest that were COVID losers that are seeing improving net migration inventories kind of still well below COVID levels, and employment that's actually holding up. So what we're looking at are really all-in prices, we think in 26 that will be down about 0.8%, barring affordability doesn't improve dramatically. But
Okay, so there you go. That's the prediction from Ivy Zelman. Remember, Ivy Zelman is one of the few, yes, the very few who actually predicted the mortgage crisis. Everybody likes to say now they saw it coming, but I actually remember those times quite vividly because I was buying homes during those times, learning the hard way about real estate. And there were very, very few real estate pundits and professionals that saw this coming. Ivy Zelman was one of the few. If we're being honest, there was only a handful of folks who saw it coming. Everybody likes to pretend now, but Ivy's got receipts. So when she says anything about the future of prices or the market or the conditions, I listen closely. And she's projecting now that next year, 2026, home prices will be down 0.8%. Yeah, I know there's a bunch of people on X, a bunch of doom and gloomers that were hoping I was going to say 80%. They actually think that's a reality for a lot of the reasons, some of which we articulated yesterday. Over 40% of homeowners don't have a mortgage. Home prices don't go down all of that much when you've printed all this money and they got to put it somewhere. They got to put it into their home. So she's got a slight dip happening in 2026, 0.8%. She left herself a little room there. Barring affordability doesn't improve dramatically, okay, a sharp decline on the mortgage. The only way affordability can improve dramatically in 2026, because that's right around the corner, is the interest rate. So she's kind of leaving herself an out there. If the interest rate drops down more than she thinks, then she doesn't believe that the drop will be 0.8%, but she doesn't even have the drop at a full 1%. So we're really talking about a real estate market that is essentially moving sideways off of recent peaks. Okay, let's go to what she talks about with builders. She talks about this a lot. She reiterated it here. Let's go to builders buying down mortgage rates and the impact on affordability.
You know, you focused on affordability, and let's talk about the builders specifically. They've been buying down mortgage rates aggressively. Your number was 73% of builders, and more than half of them were buying down by more than 100 basis points. So if they're lowering rates into the 5% range already, then we see rates come down even more by the Fed, perhaps. Then you're having affordability is improving. Yes, doesn't that send many more people into the market and therefore push prices higher?
Well, the builders have been pretty much offering mortgage rate buy downs when rates started going up in 2022. So today there are 1 to 2 years as low as 2.99, 3.99, and then for the remaining 30 years left, they'll do 4.99. So they've already been making it a buyer's market, providing very good value and affordability. So the real question is, will they keep providing mortgage rate buy downs as mortgage rates prevailing come down? And I think they will, because
it's hitting their margins. I mean, you said it.
But the margins will be less impacted because it gets less expensive as rates come down. But they have a lot of spec inventory, and it's not like wine. It doesn't get better with age. So they're motivated sellers, but the velocity that they want to keep sustained is going to be driven by the incentives. And while it might, on the margin, decrease a little bit, I think they're going to stay very active with buy downs.
Hey, I think I really like that line from Ivy. You might want to use this on your pitch today if you're talking to a seller who's been on the market 60 days. Hey, you know, us sitting on the shelf here, the Zillow shelf, the Realtor.com shelf, it's not like wine. It doesn't get better with age in the buyer's eyes. But we've got to reimagine how we're going to position ourselves to the market. We need a better invitation because a lot of people aren't showing up to this party. Price can be a component of that invitation, but hey, it's not wine. It doesn't get better with age. Pretty good analogy there. So you've got builders that are motivated and they're continuing to offer mortgage rate buy downs. And, you know, that's the game that they have to play. It becomes very competitive in those markets. And it's something that Ivy in the past has said, you should offer the same thing versus coming down only on price, some type of incentives from an existing home sale. It's a lot about what we were talking about in the BAMX role play this morning before the hot sheet. Okay. Don't just always go to discounting. We were talking about agent comp. Don't always run towards a discount. Roll down a bonus feature into that offer. Okay. That's basically what she's talking about there from a builder perspective. Spec homes versus build to order strategy to close out Ivy's thoughts here with builders.
Bring up spec homes, and there's been this kind of argument here because you showed that D.R. Horton and Lennar are 100% in on spec homes, and you said, I think that's the right way to go. I talked to Ryan Marshall of Pulte. He said, I don't think that's the right way to go.
Well, think about this. If you're worried about the job losses accelerating and builders are speccing, they're providing the consumer a mortgage rate buy down. If you do a build to order, you can't do a mortgage rate buy down. The timeline to close, call it 6 to 12 months, it's too expensive to take the forward commitment risk. So if in fact you think you want to get growth, build to order might be under much pressure. We have builders that are going into 26 with backlogs down 30 to 40%. Wall Street won't like it if they're not going to grow. Now, if you think the economy is going to get better, because rates are coming down and job losses won't be a concern, then obviously pricing power will come back to the market, and Ryan Marshall on build to order could be right. So it's really where you stand on the economy. But I think builders that are speccing are doing so because they want to offer mortgage rate buy downs and provide new move-in ready, which was demanded during COVID.
So the builders, what she's saying there is if the market in 26 does get better, like if Fannie Mae's projection is right, where you're going to have a 10+% pop on home sales, they've got to have the inventory, the spec inventory. Generally speaking, if you work with a builder and you don't have any spec and it's all build to order, regardless of market conditions, if you've ever dealt with new construction, that not having anything ready to go naturally slows down interest. It puts a cap on the amount of people that would be interested. If everything is built to order, regardless of market conditions, that can be a headwind. All right. Calculated Risk put out their FOMC preview. Okay. The FOMC preview, we went over essentially where the markets sit yesterday, CME Group as well as Polymarket. And both of those seem pretty obvious before we get into some of the banking commentary from FOMC. So 96% chance from CME Group. I think that's even up a little bit from yesterday off of the 4% chance that it's actually a 50 basis point cut. And then Polymarket has a 91% chance that this 25 basis point cut happens here by tomorrow afternoon when the Fed announces it. All right. So moving over to the Calculated Risk preview here, and what they expect to happen is this. Okay. They expect this to be a 25 basis point cut in alignment with the markets. Okay. They're looking for two changes in the description of current conditions on the first paragraph of the FOMC settlement statement, rather. So, I said yesterday, hey, I'm going to look for the prepared statement, but I'm really going to be looking at Q&A as it relates to, how the market is going to feel moving forward, because this 25 basis point cut, this little teeny cut that's coming, it's already priced into the market. Okay, it's already priced into how investors feel about the stock market, all-time high, all-time high, all-time high. It's already priced into interest rates year-to-date low on the 30-year fixed mortgage. New, fresh year-to-date low yesterday. But this is what Calculated Risk here is this is what Bank of America, rather, from the Calculated Risk report is looking for, okay? The reference to swings in net exports should be removed, though some version of the text saying growth of economic activity moderated in the first half of the year will probably stay. More importantly, Okay, the second thing they're looking for, they being Bank of America. More importantly, the description of labor market conditions is likely to be downgraded. The FOMC might opt for language similar to last September. Job gains have slowed and the unemployment rate has moved but remains low. I agree. Unemployment is low. 4.3 when you look historically, that is not anything really to be worried about. But here's what I believe. If that's the message on jobs from the Fed and there's not a clear plan attached, here's what we're going to do moving forward. I think rates actually move up. If they're kind of wishy-washy on jobs, the market expects the Fed at this point to take a strong position to react to the job market. What Bank of America wrote there was like, we're downgrading it, but unemployment still remains low. Like, I don't know, we're in a wait and see pattern here still on jobs. If they're in a wait and see pattern, an uncertainty pattern, I think we're going to see a negative reaction on the bond markets, and the 10-year might go up, pushing the 30-year up. That's just what I see happening tomorrow. We've seen this in the past where we get this momentum before the meeting, low rates get priced in, Jerome Powell comes out and doesn't handle the presser, doesn't have a plan. If you have a plan and you're prepared, the presser is easy. And these media people, you're not being asked questions by rocket scientists. You're not being asked questions by media people. Okay. If you have a plan, those questions, you should know what all the questions are going to be. They're pretty easy to answer if you have a plan. We'll see if Jerome has one tomorrow. The economic forecast from June have aged remarkably well. Growth could get marked up by 1/10 for this year, but the out years would stay roughly unchanged. We don't see any need to tinker with the path of the unemployment rate since it's on track to reach the Fed's Q4 projection of 4.5%. So, the Fed expects this number to go up. 4.5, historically speaking, is still not, that outrageous. Okay, here are the GDP projections of the Federal Reserve governors and Reserve Bank presidents. Remember, the June updated had GDP 1.2 to 1.5 here for this year. March, it was 1.5 to 1.9. So it's down from where they originally thought. GDP in 26, 1.5 to 1.8. 27, 1.7 to 2. Okay. Projections of change in real GDP and inflation are from the fourth quarter of the previous year to the fourth quarter of the year indicated. Unemployment rate, they've got us ending it at about 4.4 to 4.5. Next year between 4.3 and 4.6 and 4.2 and 4.6. These are more normal numbers on unemployment. So unemployment is still considerably low with all of the weak job reports that we've had. And then inflation, 2.8 to 3.2 is where the Fed still the current projection is. And we're still within that range. Okay, so that's the full projection here of what to expect from Bank of America and other analysts here. These new projections, the projections that I just went over, are going to be released at this meeting. So what we just reviewed was June. We're going to have new, fresh projections and, how some of this data going to impact those projections that we've seen here over the last 3 months remains to be seen. One thing we know for sure, we went over it yesterday with CPI, is they're not going to acknowledge the most relevant data as it relates to inflation, and that's the rental report. Realtor.com puts out their August 2025 rental report and shows now 2 years plus, not 1, not 2, but 2 years plus of declining rents. And with that now competition in the rental market, renters are ready to make a move. They have flexibility in their options. Okay. We're at 25 straight months of year-over-year rent declines for 0 to 2 bedroom properties. And this is, since data began in 2020, You don't see this, okay? Asking rents dipped by $38 or 2.2% year over year. Not a ton of money, but the declines are consistent 25 straight months. It doesn't show up in the CPI. It doesn't show up in inflation, this real-time accurate data. Why? Because they use owner equivalence rent. It's an outdated survey from 1980s. You can go listen to, past hot sheets or yesterday's when we talked about it. And it's 2 years lagging. Jerome Powell has admitted, hey, the shelter data is 2 years lagging, but then he wants to cry about inflation instead of getting up with real accurate data. Fed's in a tough spot. They use government data, which is inconsistent at best or inaccurate at worst. Not inaccurate because somebody's trying to manipulate numbers. I'm not claiming that. Inaccurate because of the inefficiencies of government. Realtor.com they've got to put out great information or they go out of business. The Bureau of Labor Statistics really has never been threatened until Doge came along, and they're still operating today. Okay. The median asking rent for the 50 largest metros registered in at $1,713. Okay. So rents, again, 25 straight months decline. Nationwide rent is 2.6% below the 2022 peak. Okay. So I would argue that real-time rents, have actually been disinflationary, while the CPI and the data that the Fed is going off is showing the opposite. Okay. This chart tells the picture of where we are in real time with real data. All unit sizes saw rent declines. Okay. Studio, 1 bedroom, 2 bedroom, all continuing to decline. Okay. And median asking rent for studios fell by 1.7%. That's 24 straight months for studios. Median rent of studios was $1,430. Okay. That's down $51, 3.4% from the peak in October 22. The median asking rent for studios was still 13.3% higher than 6 years ago. Yeah, you're not going back to 6 years ago prices. Okay. It's not how the world works. Rent for 1 bedroom units slipped 2.1% in August on a year-over-year basis. Under $1,600 for 1 bedroom, $1,593. 27th consecutive month of annual declines on the 1 bedroom, $67 lower than the peak back in 22, but still $207, 14.9% higher than August 2019. 2 bedrooms dropped 2.2% year over year, 27 consecutive months there as well for annual declines. Median rent for 2 bedrooms was under $1,900 at $1,897, $60 lower than the peak, which was August 22. Larger unit rents had the highest growth rate over the past 6 years, up by $298, 18.6%. And here is your table. You can get some, these charts and everything inside of School for BAMX members, school.com/BAMX. Overall median rent tick over $1,700. It is down 2.2% year over year, and the 25 consecutive months of a decline. These are the real-time numbers that you would hope, a government, an economy like the U.S. economy, as sophisticated as it is, would be utilizing when making these decisions. The decisions that are going to be made tomorrow by the FOMC, by Jerome Powell and the committee, are not going to consider this data. They're not going to consider real-time accurate data. The Fed only uses government data. Inefficient at best, inaccurate at worst. And we've seen this over and over and over again. That's the data they're going to use to make their decision, which is why, in Jerome Powell's defense, he often wants to wait, at times too long, like he did in the beginning of inflation, because he's waiting for this data to be obvious because it's lagging in such a degree. I don't know if he uses an iPhone or an Android, but maybe he could just take a peek at the hot sheet and get some of this data. Okay, why are you moving into a new rental home for renters? The number 2 reason, really tied for one, is to get a more affordable home. Number 2 reason is want a larger space. Okay, now you've probably seen stories on this because there's so much competition right now in multi areas where they've built multifamily. Like some people are like, hey, I can move out of this building, move into another building, get bigger space and get $50 off because there's competition, and to attract new tenants so you don't have vacancy, there's some of those bonuses that are being offered, like builders doing rate buy downs, or like we were talking about in the BAMX role play this morning, creating a roll down offer, a premium bonus to get the compensation that you deserve. Same thing here in the rental community. Like, hey, I'll throw in a couple months, I'll throw in a larger space at a lower price, whatever the case may be. But the top 2 reasons people would consider move: more space, which actually aligns pretty well with, these could be future buy. If you want more space, if you're looking to rent more space, maybe you're a future buyer, and certainly more affordable homes. And moving out sometimes is the option to get that affordable home because you're tied into a lease with increases. Like, hey, I'll just go out there and move, competitive landscape, get that more affordable home. So those are the top 2 reasons people will move into a new rental home. Different neighborhood vibe, number 3. So different location there, better location, or just better vibe for that person. Current living arrangements are no longer available. Got to move for work, closer to friends and family, and there will be more people living with in that household, looking for more social community, need to downsize, and then you get down to these bottom reasons. There are fewer people in the household, looking for more community amenities, and move to a better school district actually is the last case scenario. Typically, school districts are tied to buyers, and so not surprising that is there at the bottom. If you look at every age group, you have affordable home, and larger space pops up there as well. But wanting a more affordable home is in the top 3 for every age category, 18 to 24, all age categories, all the way up through 65 plus. So people are moving to find more affordability, and renting right now does offer a lot of affordable options versus buying. Here are the trade-offs that renters are willing to make right now for the affordability. Okay. Lower on-site services. Okay. So that's the tops. 43% don't need a ton of on-site services. If I can get my affordability box checked, move to a place with further commute distances is up to 40%. That one's surprising to me. Like, people have gotten a hit of that sweet work from home nectar sauce, and now they don't want to, I feel like people don't want to commute far, but I don't know, 40% said, hey, if it saves me money, I'll do it. Move to a place with less desirable community amenities, 31.9% willing to give that up. Downsize spaces, 30%. And then find additional roommates, 13.5% there. Okay, those are the things they're willing to give up. Here's the big one. Do you have plans to become a homeowner in the future? Here's what renters said: 1.2% yes within a year. Okay, only 1.2% of renters are fully committed within the next year. Okay, in the next 1 to 2 years, you got 31.1%. So I don't know, maybe Ivy Zelman looked at that and said, I feel better about 2027 than 2026. Remember, she, at the beginning of the show, said 2026 has prices going down 0.8%. 2 to 3 years, 13%, 3+ years, 14%, not sure, 25%, and no, 15%. So not a huge number. 1.2% of renters say within the next year, according to realtor.com here as of August. Okay. There you go. There's some more notes in there inside of Hot Sheet Notes that you can download, and Metro got all the metros listed out there. Just go to Into School for BAMX members and hit Classroom here at the top. go down to Hot Sheet and just hit today, and you get access to all the slides I use right here. One click, whether you're on the mobile application or on desktop, just hit the down arrow top right to download those, as well as the Hot Sheet show notes, how I make the cake over here in Hot Sheet land. You can also get new templates and content every single week. August is closed. I'll get into September here now. And new hyperlocal content and templates ready to be branded for you. We drop new content every single week, as well as blogs and video scripts, all for you, and email newsletters right into your new this week template here on inside of BAMX on school.com/BAMX. All right, 10-year here to start the day, coming in at 4.034. Not much of a change here that we've seen over the past week and a half while we've had this momentum. I don't expect much to change until Jerome Powell talk tomorrow. Yesterday, we did hit a new fresh year-to-date low on the 30-year fixed at 6.25. We've been in that 6.25 range, hovering just above it here for quite some time. We'll see if Jerome Powell can create more momentum by having a plan, or if he stymies that momentum with a lack of a plan when he speaks tomorrow afternoon. Prepared statements first from the committee, and then the presser with the media. All right, I will be in Orlando the next couple days. I'll definitely be with you for the recap of Jerome Powell for Thursday morning show. But I am speaking at the Sell It event tomorrow, and then Jared James event in Orlando. Next week, we've got BAM Camp. If you're going to be at BAM Camp in Scottsdale, I can't wait to see you there. That's been sold out for a month, so my apologies. There are not any last-minute tickets, but if you would like to catch me and you're located in the Denver area, driving distance, or traveling into Denver, October 24th, I will be giving a morning keynote at the Fusion event. Okay. Fuel your growth. Join the Fusion rally. Okay. It's a one-day event, and I'll be speaking at this. Industry leadership, keynote speakers, including myself, Rory Galad, Michael Valdez, CEO of LPT International, amongst others. So if you missed me in any of these events, go to the link down below and join. Sign up for Fusion. 37 days, Denver. Looking forward to being with many of you guys there. There's a code for that, BZ25. Use, and you'll get a deal on those tickets. Looking forward to seeing you guys there. All right, there's your hot sheet here for today. I will see you very soon. Until then, toodaloo. I always have to bottom button.